When could you begin to see it in here instead of all the way back here when it's too late, right? What do the fifth graders say? It's bearish when it's down here. They should be saying it. Edge guys will say it in here. It's probably getting bearish, right? Or one of the fifth graders saying it's bullish up here. Well, no kidding. But down in here would be obviously, what could you see to say I'm bullish in here instead of having to wait to here? That's what the difference between an image and then being able to try to recognize is real time. The big difference is you start to see a pattern of people getting stuck. Let's start with the head fake. And I've gone over this a lot of times, and I think every time I do it, people like it even more. But if this room, half of the room, is short, we'll start with Phyllis. You guys are all short, so you guys want the market to go down. From Phyllis over, you guys want the market to go up because you're long. Now, there's a fight in any market. The chop is usually a great place to recognize that fight. Longs want it to go one way, shorts want it to not only go a different way, but the opposite way. Well, we're going to have to clear some people out. We're going to have we got to have the bodies, we got to get rid of the bodies. So we need a cleaner path to where we have to go. So when the market starts to, if this is the assumption that this is a fight, and I think I've put a box around it, and I did. If this box is the fight, where you guys are still in the market, open longs and open shorts, all of a sudden when you peek through the top, what happens? Who's happier when you peek through the top? The longs or the shorts? What are the shorts saying? Say collectively say, ah. What are you guys? Buyers or sellers now? You're short. You are? Buyers. You guys probably said, oh, because you got stopped out. You're stopped out because that move, are you guys buyers anymore? No, you already got stopped out up here. When it jumps down in here, you guys say, oh, again. Oh. Why? Because you got stopped out and it went your way. Happens all the time. How many people have gotten stopped out and then the market goes your way immediately? Everyone should have. Never happens a day. So that's that moment. But guess what? The second from the shorts, they're cleaned out. They're no longer buyers. They're no longer buyers. But the people who are long are still long because these guys are greedy. These guys want to see it go through this chart and all the way up, and they're going to make their month in that trade. Everybody's greedy, especially when there's emotion and open. Most retail traders are all greedy because they don't understand. They don't have many opportunities to take profit, so they're not good at taking profit, right? And I'm not saying you guys are all retail. I'm just saying there's a ton of retail business in the market, and they want big winners, right? Before I was, a guy told me this, but Anthony, he says, I like 10-handle winners. And I says, Jim, I like 2 blondes and a brunette when I was single, but it ain't practical. So you got to be practical, right? You notice I told you a joke today and not yesterday. But it's just to get you guys to remember that be practical. You're greedy. You guys are long. You're still in the market. And the market came back down. Now you guys say, yeah. Well, all right. Guess what? They're still short, or not short. They're still long, and they're still sellers. You guys are not buyers anymore, so it's easier to go down. And there's still sellers in the market. So the head fake out of the top of the box, then back through the middle of it, usually creates a probability that there's a transition, right? Because there was a winner, there's almost a winner, there's not. It's just like watching a sporting event. All the team had to do was make that basket, and the game was over. They turned it over, and boom, it's that quick, the momentum shifts. You can go back to that moment. Well, how do you go back to that moment live? You're probably good if you're a sports fan. Well, get good as a trader. When does the moments happen? If this is just not relevant to short time frame, you could use different periodicities and time frames to find when the bulls give the leash back to the bears. As Chuck pointed out really well this morning, the bulls keep jumping in the driver's seat on a medium or longer term perspective, right? Bears will have on a medium term perspective, get the leash, you think they have it, wham, the bulls keep coming back and keep coming back. And that's generally the definition of a bull market. So now we're going to get into why this would be a bearish bar. Not at the end of it, but towards the top, because you identify this little pattern that came out in and out of the box, correct? So in the room, you guys would see me make this, color this bar pretty quickly. Probably, you know, really at the top. Once I see this hold in here, I'm feeling that it's really bearish and this could happen. It's a probability, and it works every time. No, but you get the sense that the bar doesn't have to close before you make it a, hey, bears are in control. Now, funny thing happens. The market's opinion changed, and it changed through the very next bar. You guys have to remember yesterday what changes each P&F bar, and it's the fact that in a 4 P&F, you got to get this bar is an up bar, you got to get 4 ticks off the high. So it's easy to assume to say, wow, this thing is a pretty long up bar, right? And you're probably getting all these guys nervous who are short. I'm going to flip this around and we're going to do this exercise. The last exercise we're doing as far as with participation. Anthony, get in the same row as Bryant. Bryant, stand up and face that way. Face that way. Robert, would you help me out? Stand with those two guys and face that way. You won't feel a thing. Go in the aisle a little bit. Go in the aisle a little bit, Bryant. No, the other, I'm sorry, go in the, behind the seats. You two, all three of you guys do it, because I got to walk up there. All the way down, sorry. All right, Robert, get up there with him, if you don't mind. So you guys are nothing right now, right? You're not doing anything, but you're going to do something. I'm price, all right? Carl, I'm price. We're going to go up. Price is going to literally go up and go up fast. This is a big up bar. When it goes up and it goes up fast, what are all the little Johnnies in the world doing? Are they bullish? Yeah. They're not bullish down there. They weren't bullish halfway. They're bullish now, right? What are a lot of people, more or less? If Johnnies are bullish, they're bullish, right? That's fine. That might work. But when it doesn't work, that's when they're trouble. These three guys are like little Johnnies. They're facing me because they're bidding the market and they want to get in on a pullback. But they're smart. They're not going to buy it up here and reach. They're going to say, damn thing, move from there to there. I'm going to buy a pullback. There's nothing wrong with that. So as the market, on the price, comes up here and turns around, all of a sudden, turn around with me. These guys get filled. They're long, and they're wrong because the price is down in here. Put your hands on your head like this, if you don't mind. That's longs who are trapped. Price is here. Longs who are trapped are sellers. So watch when I try to go back up. Market tries to go back up. There's a lot of stuff in the way. There's a lot of sellers in the way. It's hard for it to go back up. So this would have been a transitional moment from bullish when I was up there to bearish when I was down there, and it'll stay bearish because of that resistance, that trap. Buying, they're now sellers. Thanks, guys. Appreciate it. That would be a long up-down bar. This is a long down-up. No, this is a long up-down bar, right? You were right. It's the opposite example of this to tell you that obviously you can go both ways. Everybody that we start here and go here, all little Johnnies are what? Bearish. They're all trying to sell it in here. They all get picked off. They're trapped. Rally through them. They're all buyers in here. That's why the market finds support. It goes from bearish to bullish on this image example. The real example was just the opposite. I'm just trying to give you guys the sense that the best chance that you'll remember stuff is from this interactivity. And sometimes you know something, but you forget it, right? And it's, again, your mind doing things that, if it's not trained properly, screws you up. All right, let's move on to this new imbalance. We got any questions on B2B charts before I move on to this thing? No questions?
Well, how would you increase the odds that the head fake would work?
How do I increase the odds?
Yeah, like what would you need to see to think that trade is worth taking as a head fake?
Tempo. Something else moving. So here, you asked me how to increase the odds. Start to see the pattern of this particular pattern, which is going from shaking out shorts,
Right.
longs are stuck, What increases the odds? This is the S&P chart. The NASDAQ getting slapped. The Russell getting hit. An ETF that's been driving us gets whacked. Something that might provide a little bit of a lead. It's not that easy all the time where there's a lead lagger in every instance. There used to be better stuff of that. But there are moments when you're already bearish, just looking to sell it because you begin to recognize this pattern and you want a higher probability, get an ancillary to cooperate, to lead you right where the market wants to go. And that's where ancillaries are important.
What about Delta?
Yeah, Delta, like Dr. John said, could be anything if you find that it helps you personally, right? So I might like an ancillary better than Delta. That doesn't mean that the Delta is not as good. Or someone could flip a coin and says, Anthony, I found a flip of a coin works when I start to see this pattern. What am I going to do? Tell them you're a liar? Now, obviously, that's an extreme example. But I would never discredit someone's, like, when we were training guys, we would never tell them, that's a stupid idea. Like when they wanted to trade something, I'm thinking of getting long here, and we would tell them, that's a dumb idea. And the reason was, is that who the hell are we? Do we have a crystal ball? Man, maybe this guy figured something out. Trade it. Now, who are we if you screw it up? We are the ones that tell you you sucked and the idea sucks because you can't make any money. But when he has the idea, who are we to say it's wrong? We're only able to tell him wrong when he has no proof.
I'll just tell you, the head fake pattern in the NASDAQ works, happens a lot. You get a real move to the upside, takes out, and then consolidate, takes it out, and then bam, straight down for 20 hands.
This is why questions are important because it brings up something that either I forgot to mention or anything else, but very true. This is more of the the ES, but different markets are going to have this work more frequently because they move more. So they're constantly, yeah. Do you find it as a transitional moment, helping you?
Yeah, it's huge. I mean, because once it breaks above, and then it's like the delta, it's a delta thing. The delta expands, and then it breaks above that level, and then whack, it goes for 20 handles. It doesn't go for 5.
You want to be anticipating. Your anticipatory skills are.
But you feel like it's not going to happen because it's going up.
Well, great. That's why it
You feel
worked.
like, holy shit, yeah, exactly.
Yeah,
Like
I mean,
everyone's chasing it.
do you ever think, and the guys that have been trading for a long time will nod their head rapidly, the trades that you have a lot of confidence in, they're the ones that bust your stones, and then the ones you're right, Chuck, the ones you're a little nervous, I'm not sure about, maybe I'll take it, and you'll put smaller size on, effortless. And that's kind of almost like a product of it working, because others felt that way too. Other good traders felt that way too, so there's less good traders on the team.
One of the really good traders I work with tells all of us that if you can't identify someone on the other side of your trade that's trapped and potentially in pain, then you don't have a trade.
A great way to say it.
The way you're laying this out.
Yeah. And it could be from a pattern that you identify the pain, and it could be from a delta, it could be from an ancillary. That's one of the things I always say is markets don't move because they don't move because people enter, they move because people have to exit. You're only nervous and emotional when you have to exit. If I'm buying a house, I like to buy it from a divorced couple because they want to get out. So where's price going? Down. They hate each other.
One of the areas I get confused on is what if I have 2 long down bars on the left here? Suppose the box wasn't there. I just had that little, say that 4 level thing. Yeah, but I had a long down bar instead of that box, right? So maybe you can say you got the little up bar in between, but assume there's a long down bar.
Well, which bar? This bar would be longer?
No. Say it started at the top higher. So that wasn't congestion. It started at the top higher. So you had a long down bar. Then you had the 4 level upswing, and then you have the next long down bar.
Right.
Okay, so if it was positioned that way, where I get a little confused is, when do I consider that a bearish to bullish term?
Well, this would be bearish, right? It would be bullish to bearish. You're right. When?
Yeah,
Well,
on the right-hand side, like when you're looking at the chart on the right-hand side.
without being too scientific, and guys in the room could attest to this, I'd be turning it I'd be thinking of turning it when I see this pattern, but I wouldn't turn it till I seen this. Probably after this red, right in here. Yeah. You want to make sure that when you're doing this, that you don't have to wait always for the bar to close, because you just want to be ahead of the transition. Now, you also don't want to be throwing 1,000,000 of these things up, because then you're not following the market's opinion correctly. That's why opinions are so important to review. I mean, not opinions, but your skill, so important to review if after the emotion is detached, if you're, hey, I got this. That's where confidence comes, where you got to actually, you could quantify, hey, I'm getting this thing when you go back and look at it. It doesn't have to be a P&L. It could just be, hey, I called that one right, I'm calling these right, I'm calling these right. Now, all of a sudden, something turns into a skill. But review is important. And I give guys examples of how to review. I'm not going to get into it now, but I give guys examples of how to recreate real time and see if you're able to predict the next move, the next bar. Because I always say, no matter if you're a long-term or small-term trader, number one, you got to get in real time, you got to get out real time, and the market has to move 2 ticks before it moves 20 in your way. You just got to, you got to work on location. Me finding a location might be different from a guy like Chuck, who seems like he's longer term. The principles and the foundations are the same, right? We're determining locations. The hold times are what's different, but we're still working on location. We're still working on how to find better location. Anything else, John? Anybody else?
Anthony, are you using the imbalance, like you said, the red, that second, the top of the bar, the second box? No,
Here?
I'm sorry, where it starts to decline, right there, that second box has the red imbalance. Are you using the imbalance to help you?
That's part of where it leaves green or red behind, yeah. Because that's showing you tempo. Now, here's the thing, Bill. I don't have to look at the footprint to assume there's red and red imbalance. I could be looking at my dome and I could say, it moved down fast, it's going to look like that. I don't have to look at it to see it. So I could make that decision that it's a bar and click on it without having to look at it. Because I could chart the market in my head by watching the price action of a dome. Another exercise I've given to people, quote the market. So what you could do is you could actually chart the market in your head without looking at a chart. And then use your charts as reference. But you can already assume there's a red imbalance there because you're watching the dome and following the tempo of the move lower. But to answer your question, yes, that tempo to the downside means, hey, these bears are really going to start pushing out some more longs because the longs are PO'd that they thought they had some success. They thought they were there at the finish line, and wham, they come back down. And it also allowed shorts to get pushed out. Therefore, there's less buyers below. Less buyers below, it's easier to go down.
So where would your entry be in that scenario? And would it be
I don't trade this thing. Are you crazy? No, I wouldn't put anything on. It would be, well, go back to your question, or not your previous question. First of all, I got an ancillary. I'm going to find a better location. So location to me isn't always price, it's time. For instance, you could be short here, or you could be short here, and I could be short here, and my trade was better. And people would say, well, no, this is a better trade because it's higher. I'm short from higher. It's all timing. The guy short from here probably will scratch it as a shorter term trader, or maybe not scratch it, but take less profit because he took heat. The guy short from here is going to take more of this move out because it was more effortless. He didn't have this scar of taking some heat. Now, this is some smaller time frame stuff. But the point is that he had a scar, he didn't. Where I'd want to get short would be as it moved through the middle of it. With that being said, I might be the one short in here, not down in here. Now, it didn't come against you too much. But so either here, but then there's that whole idea of I don't know what else is going on. Are the bonds and yen working opposite stocks today? And if they are, and they haven't been lately, then that's going to be a factor that might get me short better, and he might be later.
Why don't you just take it when it comes back in?
I don't know if it's going to come back in.
Like,
Hey,
where
this
the
bar
head-
could be
you
this
get the
bar.
head fake, you see the head fake up above,
Mhm.
and then when it comes back in,
Well, you can, but here's the thing. We're always afraid of missing it. So I don't know this bar is going to come back in or give me a second chance, and I'm thinking this bar is going to be this bar.
I mean, the point is it's a head fake, so it shakes them out.
Yeah.
And then when it comes back into the consolidation, you got a sell stop right 2 ticks below it or whatever, the top, the breakout bar, and
Right.
it fails. So then, then you just see what happens.
Yeah, and I don't have an argument for you. That's not a bad idea. It all depends on the, yeah, well, the context, right, the volatility of the day. Do you think you have time to do it? Is it volatile? And these head fakes are playing out faster or quicker and everything else. And you know what? It doesn't even necessarily have to mean you're going to play this and get short. It might just give you an opportunity to execute some other setup, right? Maybe it's another setup that you had and say, now I'm going to start playing it from the sell side. And then you see this and you go, nope, too late, I'm not going to do it, And it's just building out the story to give you, hey, listen, I don't mind. If you mind being wrong, you're in the wrong business. But it's like if you say, I'm trading this as a head fake and I'm wrong, I can live with that. I had a pattern, I had a reason, and I executed it, and it's part of the job. It's part of the job, right? It's a marketing outlay. It's a check you have